Hey, good morning, everyone. Welcome to our fourth webinar in our Portfolio Analysis Mastermind. And this one is all about supercharging your returns in real estate. And it's going to focus on depreciation, which I think is one of the most powerful ways to make money in real estate. It's also one of the most misunderstood. So we're going to go through what depreciation is, go through an active example, and go through a fund example. But before we get all those details, have to give you a disclaimer that this is for illustrative purposes only, and we will be talking about tax stuff. We are not your CPA. We are not licensed CPAs. So make sure you talk with your professional, your CPA, your cost segregation person, your lawyer, your team, as you implement this stuff into your real estate portfolio. If you need referrals, reach out. We're happy to share our team with you. So as I said, this is the fourth webinar in Portfolio Analysis Mastermind, and we're really going to be covering all the depreciation stuff. And so I've got a panel of experts on here. My name is Chris Lopez. I'm the host of it, also the founder of Envision Advisors and a general partner at Iron and Capital. Lon Welsh is not on this webinar, but you've heard him on other ones. We've got Jenny Bayless, who's one of our portfolio experts and also an investor and Envision Advisors team member. Good morning, Jenny.
Good morning, Chris. Happy to be here.
And we have a new face for today's mastermind, Vital Elion with Ironton Capital, here to talk about depreciation. Good morning.
Hi, Chris. Delighted to be here.
I'm very excited. And the last but not least is Aaron Klingscales. Aaron, what's up?
Hey, good morning, guys.
All right. So this is going to be, before we get into it, depreciation is a heavy concept. It is a meaty concept, and we want to keep it very much focused on the high-level conceptual stuff, so you know the key points and can walk away with a good understanding, so you can go out there and do more research, and of course, talk with your tax team as well. So, as I mentioned, this is the fourth webinar. All these links that we're referencing today will be put into our student handbook section. So you can grab the link, and Aaron, maybe you can drop the link in the chat box as well. And if you don't have your Property Llama account set up yet, get with the program. Please go set up an account, get your properties in there, so we can go out there and do a free 30-minute portfolio analysis session with you. Aaron will drop the link in the chat in a minute. It's in our student resources, or you can scan the QR code. And really what the goal is here is we're providing a lot of high-level conceptual information through the webinars. Property Llama is providing a lot of the day-to-day data and numbers and current performance of your rental properties. And the goal of this advisory session is so you can have one of the experts, me, Jenny, or Aaron, sit down with you for 30 minutes and help you kind of take what you learn, look at the numbers from Property Llama and align that with your goals to come up with some action plans. And then we get you the plan in place and get you connected with the referrals and team members that you need. All right, so to transition to cost segregation and accelerated depreciation, Jenny's going to take over here.
All right. Can you guys see that?
Now
Perfect.
we do.
All right. So I think depreciation is kind of a little known topic in real estate, but it's one of the most powerful topics that I think any real estate investor needs to kind of wrap their head around. So we often hear about real estate investors that brag about not paying taxes. And, I think a lot of people are wondering out there, how are they able to do that, without doing something illegal? And the way that they're doing that is mostly through depreciation. So as we discussed over the last 3 weeks of PAM, that return on equity is all about momentum, being able to re-leverage that property, being able to sell it, and then expanding your portfolio and rinse and repeat as time allows. Accelerated depreciation is another way to gain momentum. And this one is actually a momentum on your cash flow. It's through tax savings from your rental property, and then being able to redeploy that cash that you saved through not having to pay your taxes legally, and redeploying it back into being able to purchase additional investments. So going over just a really quick and dirty, what is depreciation? It's an accounting method that's used to allocate the cost of an asset over a useful life The IRS has defined these useful lives. So it's 27 and a half years for residential real estate, 39 years for non-residential real estate and STRs. And then there's various components within the real estate that have different schedules, such as 5 and 15-year property. And remember that land is not depreciable, meaning that they don't think that the useful life of land goes away. It's just dirt. So, it's there. And then something that's important to understand is that depreciation is a non-cash expense, or you might have heard of phantom expense. So you could have net cash flow positive on a property, but then you could have a tax loss. And the reason for that is depreciation. So I'm not going, go ahead.
I would say, yeah, before you move on to that, I just want to, because you did a great job of covering a lot of, key points there, Jenny. And, don't get stuck on the details, listeners out there. Really stay focused on the concepts, and all these different names. Just realize these are different ways that you can manipulate and use depreciation. And this is where we want to do some heavy research and talk to your CPA. Just get the genesis of it. So sorry, go on, Jenny.
Yeah, so this is another topic. Just ask your CPA, what is bonus depreciation? They'll be able to, kind of explain how that fits for you. But just generally speaking, under the Tax Cuts and Jobs Act of 2018, they wrote into effect that assets with useful lives of 20 years or less placed into service after a certain day, they can be 100% depreciated in the first year of service. And another key point is that after this year, after December 31st of 2022, 100% bonus depreciation's waning down to 80%, and it's going to decrease thereafter. But the, important thing is that even if there's no bonus depreciation, by doing a cost segregation and finding assets with a different asset class, so 5-year, 15-year, it's still on an accelerated schedule if you compare it to the 27.5-year schedule. So just keep that in mind, that even if you've missed the boat in a few years from now and you can't take bonus depreciation, even if you perform a cost segregation study, just think that you're accelerating the schedule of certain assets. And so in other words, bonus depreciation accelerates an already accelerated useful life schedule. So, making cost segregation even more powerful, especially in years like today.
Great explanation there. And Vital, I want to loop you in here for a second, just on the concept of depreciation, because as we were prepping for the slideshow, you had some really good, I don't know if metaphors or analogies is the right word for helping people understand how depreciation can really supercharge your returns. Can you kind of give a little high level cases how people can use depreciation and what that means for their portfolio and risk adjusted investing?
Absolutely. Depreciation is a non-cash item, meaning that it reduces your taxes, but it does not affect your cash flow. If you're an active real estate investor, you can use this depreciation in effect to overcome taxes in just about anything else. It could be money that you have made in the stock market, not today, of course, but in the past, or money that you have made in other real estate activities. If you're a passive investor, it's a little bit more restrictive concept, meaning that you can use it to counterbalance only real estate gains. That is generally true in investments outside of your IRAs or your 401ks. Inside of IRAs and 401ks, the use of depreciation is basically non-existent.
And we'll go into a lot more details on that in a few minutes, but that was perfect. So thank you. And I know, Jenny, you got an example, and Robert made a comment on there. IRS requires depreciation deduction, not an option.
Mm-hmm.
Correct. Now, doing cost segregations, accelerating depreciation, I believe that's at the option of the investor. But let's go through this example because I think this will help people understand the concept of it, Jenny.
Sounds good. All right. So this is based on a property that I bought in February of this year. So I bought it for $800,000. And from that 800,000, we can then further divide it into land value of 100,000 or total improvements of 700,000. So again, land is not depreciable. Oh, go ahead, Chris.
I was gonna say, and this, you said a property. This is a fourplex in the Springs,
Yes,
right?
exactly. Mm-hmm.
Yep.
So we're going to take that 100,000. It can't depreciate it because it's land. So let's, put that out of our mind right now. So as Robert pointed out, you have to depreciate these $700,000 of improvements. So we have a couple of choices at this point as to the method in which we do it. We can either do standard depreciation or accelerated depreciation via cost segregation. So if we were to pick the standard depreciation, we would just take 700,000. There is a table, it's not going to be a perfect straight line for the first year because I did buy it in February, but for all purposes of this, keeping it simplistic, you would pretty much just divide it over 27 and a half years, the 700,000. However, if we decide to do the accelerated depreciation via cost seg method, now we have three different options for our property classes. We have the 27 and a half year property, we have 15-year property, and we have 5-year property. And I put question marks there because that is not for me to decide. That is for the engineer to decide. So let's go ahead and compare the two options that we have. So I went ahead and I got an engineering-based cost seg study done. And the engineers determined that I had 5-year property in the amount of 130,000. I had 15-year property in the amount of 33,000. So then they also determined that, since I had that 700,000, and I know it's not perfect rounding here, so just bear with us for the sake of example here, that the remaining building, the 27 and a half year property, is about 535,000. So again, without cost segregation, I would just have that flat 700,000 that I would depreciate over 27 and a half years. But the cost segregation specialist came in and said, nope, I can actually, from the 700, I can further define into different class property, 130,000, 33,000, and then the remaining balance defers back to your 27 and a half year property. So let's kind of just see how that plays into, taking it into real life here.
And so go back one slide there, and this is, I want to make sure because you went through that so smooth. Look at that year one upper right, those last two columns. If you don't do the cost seg and accelerate it, you get about $22,000 in depreciation benefit. If you do, you get about almost $160,000 in depreciation benefit.
Well, actually, you get 180,000. This is the net difference between the cost seg study. You would get 181,000 versus just standard straight line is 22,000. So you get an additional 160,000. Yeah.
Thank you. And stop and think about that for a second, guys. I mean, that is a big difference. That's like the thing to take a step back and realize that really front loads some stuff. And Jenny will show us what it actually means in dollars in our bank accounts.
Exactly. So again, this is just that same chart that I brought from last time. And just, to kind of highlight, this goes down, to 28 years. I just didn't feel like putting, a million lines down here. So the reason why this adds up to 534, you would just pretend that there's a $19,000 row every single until the 28 years is up. So basically what this is showing is that let's assume you're in a 32% tax bracket, and let's assume, we'll get into the caveat later, that you can take all of the depreciation. So that's key. In the first year, with cost seg, it's 181,000 based on what we just went through in the previous slide. And then again, without cost seg is 22,000. So if you were to assume a 32% marginal tax bracket, that your tax savings in that case is about $58,000 in actual dollars with cost segregation. Without cost segregation, it's about $7,000. So that's a dollar for dollar difference of about $51,000. And that's like true dollars in your pocket because we've already applied the tax rate to it. And that's on your marginal, so your next dollar earned. So a lot of people have questions about, okay, well, you've just front loaded all of your depreciation into year one. Isn't that going to cause me an issue in subsequent years because I've taken more in year one and now my subsequent year depreciation is lower? So again, 2023, 19,000. If we had just done straight line, now it's 25,000. And remember, the difference between year one and year two is just the proration of when I purchased the property. So you're right. You don't get to take as much depreciation in year two as you would have because you took the cost segregation in year one. So there is a difference of about $6,000 between your year two depreciation, which translates times your tax rate to about $2,000 in real dollars. So basically, to boil this down, in this situation, would you rather have $50,000 today and $2,000 less next year? That is the question that you have to ask yourself, assuming that you can take all of the depreciation. So to me, I would rather have $50,000 today. I can do a lot more with a chunk of $50,000 than I can with just, a $2,000 additional benefit in subsequent years if I were to go about this.
Yeah, this is a great example, and I think really illustrates the power of depreciation. Because another financial concept to look at is the time value of money. $50,000 today is worth more than $50,000 10 years from now. But even this, we're getting a big chunk of money a day, $50,000. That's a meaningful amount of money in real estate I can go do something with. $7,000, I always take it. But in terms of real estate, $7,000 is not going to buy you much. I can throw it in the stock market easily. I can throw it in the bond market easily, but that's not usually where I want to throw my money. But if I get $50,000 back, that is a down payment. That is an investment somewhere. Like, that is a big amount of money. And so that is like, you look at this, but the second part is what Jenny said earlier, is having that momentum. You have it. What do you do with it? Because that's how you supercharge returns. Great. We get the cash today. We have to go out there and reinvest it because, sitting in a 1% savings account isn't that exciting for me and most investors. So we got a couple of questions here. Oh, go ahead, Aaron.
Yep. Yeah, just one quick question. Considering that this cost segregation was done on a fourplex, does it change or is it variable based upon the type of property?
I don't know. I would imagine that it is because, like, for example, a condo, sometimes they don't have land associated with it. So there would not be land improvements, determined on the cost seg study. So, and I've always been told that the higher value of the property, the more beneficial this would be. Like, if you have $100,000 property and let's say 20% is allocated to land, now you're only working with 80,000. That at that point you need to determine, hey, is the paying for a study worth it in that case?
So we got a bunch of questions in here. I'm going to answer some of these, and then we're going to shift over from depreciation on a rental example to doing it on a passive example. But I want to make sure we answer these key depreciation concept questions so we don't lose anyone along the way. So Peter asked, the new rules bring some of your depreciation forward, but over the life of 27.5 years, is the total depreciation the same?
Yes.
Yes, you're just shifting around when you're using it, like in Jenny's example there. Christy says, how do you determine the land value? I've seen two ways. Ultimately, my CPA is the one that puts into the IRS. But when I look at doing some quick math, I just go to the county assessor's website and they show you, hey, your tax bill is, $3,000 and $2,200 is for improvements, $800 is for land. I just do some fractional math there and figure out, hey, that's about 80% towards improvement, about 20% towards land. And of course, that's what I do for some quick ones. Matthew says, what type of engineer does this analysis and how much does it cost? Well, there are some websites that are DIY. They're like $500. And then there are special companies called cost segregation companies. And I've seen them range anywhere from about $2,500 on up to do a full human report.
Yeah, this one was 4,000, just for context.
So a lot of times they're like 2,500 to 4,000 is what I've seen. And that's if you want a full human report versus DIY. I did a human report because me and DIY tax stuff. No, I don't want to do that. Chase says eventually you'll recapture that and much more. Yes, we'll talk about that at the end in a few slides. Some questions here. What if you have to have at least 50,000 in tax liability? Definitely check with your CPA, but typically if you can't use it, it'll carry forward. A couple people ask, is cost segregation an option? Or I'm sorry, let me start over. Lynn says, so a cost segregation option would need to be done soon after buying the property, not applicable if you had it for several years. It depends. I don't think there's any timeline on it, Lynn. You can go do a cost seg study at any time you own the property. Of course, how long you've owned it for and what you paid for it will dramatically impact it. But I bought a fourplex, and then 2 years later, I did a cost seg study. So that would be something that's worth talking to your CPA or most likely a cost seg company to help give you ideas for how that works out.
And then Robert asked, what are examples of personal property? So
yes,
15-year property, land improvements, that would be like your fence, pavement surfaces. Personal property for 5-year, that's going to be things like flooring, appliances. I think I had like doorbells listed in my report. I mean, it's very specific, medicine cabinets, stuff like that. So that's why I think that, in most cases for large assets, such as this one, I would consider $800,000 asset large, in my opinion. I will just pay someone who knows what they're looking for to take care of that for me, because I don't know what I'm looking for.
And we can share some links with some, we've done some YouTube property walks where we've broken down different segments. Also Google it. There are tables. I see a lot of same questions in here about, hey, if the loss is greater than the income and that stuff, this is where you want to talk with your CPA. This stuff gets so nuanced that we can give you the high level concept, and our goal is to give you the high level concepts, some key points, but enough to go out there and be able to articulate it to your team and make sure that they can help you figure out what to do. And I would say definitely if I've talked to some investors about depreciation, some of their CPAs are not familiar with it. That is your responsibility as an investor to make sure you have the appropriate team members that can help you get to your goals. But our goal here is to help you understand the concepts so you can articulate it to your team. All right, so we will answer some more of these questions at the end. It's getting more nuanced. What I want to do here, I'm going to, if you want to stop sharing your screen, Jenny, we're going to switch over to the passive and fun side, and give us a second here to switch everything, because this is the fun stuff, or not the fun stuff. This is where the concept of depreciation, it applies to real estate. And there's different ways to own real estate. There is directly owned real estate where Jenny and her husband, they own that fourplex in the example. And those are the two owners of that property. And then you've seen the example there for how depreciation can work. And now another popular way to own real estate is through passive investing as a limited partner in a syndication or fund. And same thing, depreciation can be applied to that real estate. Now that can flow differently based on the ask and a bunch of rules. And that's where we have Vital with Iron Capital to take us through how that works on the passive side. So PowerPoint's yours, my friend.
Thank you, Chris. Love letter from our attorney. I will not spend much time on this, but
read it word by word. Come on.
Please be aware that this is an investment that applies to sophisticated investors, and there are risks, and that is the point of that love letter. Why is this thing not?
Sorry, that was my fault.
Not to worry. I will be discussing this in the context of a fund. I represent Ironton Capital. Ironton Capital is run by Lon Wells. Lon Wells is truly a fixture in Colorado real estate. Probably a good number of people listening to today's webinar know Lon, so I will not spend much time. Lon is assisted in investment decisions by Brent Geyer and myself, Vital Aelion. I am an engineer by training. I spent the 90s either teaching in universities or consulting, the 2000s as an investment banker. Basically, I sold my soul to the devil. In the 2010s, I worked in green energy and real estate, and the 2020s are unfolding as we speak. I feel I'm growing white hair as we speak. The way that I did real estate personally at the personal level in the mid-2010s is I selected work for rentals in the Denver metro market. It was a very good market, in my opinion, at the time, and it is a relevant market to this day. At that time, you could hope to achieve cap rates. I assume that our audience knows what cap rates are in that 7 to 10% range. I would highlight that the average cap rate in the United States is in the 5s or less. So this is really double the money. And this is only the cash component of what these properties would make. The full bundle of what they make is the appreciation of the property, the leverage and the like. When you bundle them all up, you come up with an IRR, an overall return, that was a number comfortably into the 20s and a time into the 30s at that time, a short 5-7 years ago. It was a good strategy, but it was not easily scalable. You could find 5, you can find 10, you could find 15, you could build a portfolio for yourself and for your friends, but you couldn't find 100 or 1,000 or 10,000 of these units because you could no longer cherry pick in the locations that they would be available. Also, you would be faced with concentration risk. You would be buying multiple of these units in a particular complex. Something bad would happen to this complex, and many of your units would be affected. But the timing was good because the cash component was good in Denver, and the appreciation was very meaningful. At that time, Denver was growing at 10% on average, and these workforce properties were growing in value at 12 to 15% on average, and in some circles, that's real money. But this was a hands-on investment. I mean, you had to babysit these properties. You would make sure that you were collecting your rent. You would have to babysit your property manager, etc., etc. It was nothing of the automatic pilot sort.
Yeah, a little more work than just putting money in the 401k.
Absolutely. So moving forward to the early 2000s, we're talking pandemic, we're talking a very buoyant market in terms of value, but also the costs have gone high. Costs being property taxes, insurance taxes, HOA dues, and the like. At that point, the cap rate degraded, meaningfully degraded, from 7 to 10 to 5 to 7. The IRR still meaningful, but not the numbers that one would see in the mid-2010s. The opportunities were fewer. I found my properties predominantly on the MLS. In the early days, I would see 20, 30 properties, and I would be reasonably assured that I was not, if I was not in offering insanely low values, I would get one. I would get two perhaps. But now you would see on the MLS five properties, and there were 20 similar investors to mine, and you could easily end up with none. It was this time, these investments were even more hands-on. How were they more hands-on? You could not inspect them as easily. People would not welcome you to their home because of the pandemic. Uh, as people were not finding work, many of these units were crowded. The properties would suffer. That rolls us forward to today, where I personally have shifted my attention into diversified investments into other people's projects across the United States. Much more cherry picking, no longer the Denver metro area, but the southeast of the United States, the northwest, the northeast, different asset classes. What can one expect in those investments? We guide people to 17 to 20%, but there is very meaningful upside to these numbers. So I would not be surprised if we eventually manage to cross the 20% threshold. The opportunities, it goes without saying, are not nearly as few as one would find looking in the confines of the 470 circle of the great city of Denver. The risk is lower because you're now diversified across multiple aspects: geography, asset class, investment style, and the like. Is the timing good? The timing could be no better. Real estate tends to outperform, not real estate itself 5 years ago, but it outperforms investing in Microsoft or Netflix. It outperforms in an inflationary environment where you own bricks that tend to not depreciate.
Yeah.
And it is ultimately a passive participation, which means if you're a medical doctor or a dental professional or you're in some other line of business, you are focusing on your own economic activities and you're advancing those as opposed to babysitting your tenants. You also can focus on non-economic activities such as your family.
So before you move on, two things I want to highlight here is, I wanted Vital to share his investing journey because it mirrors a lot of investors around Denver where they've, they're in the market, gotten some great investments. And then, two things are happening. The market has shifted where it's hard to find the return a lot of people are looking for. And it's also true, hey, the market is shifting. What's the next, investment? So Vital represents that as also a great example of other people are doing, hey, they got a good base, but their wealth is highly concentrated. How do I start diversifying it? And so I think a lot of people can empathize with your story, and also I think it follows a lot of other people. So wanted to highlight that because I think for many people out there, your story is very representative.
I'm hopeful that this story resonates. I also want to highlight that nothing is forever. If something is good in 2015, it shouldn't necessarily be viewed as good in 2020, and it may come back. I'm not saying that this is forever either.
No, and I mean 5 years, we see where we're at. So Christy had a question here. Vital, do you still own your rental portfolio, or have you gone completely passive?
I still own my portfolio. I bought it with my friends. I know these friends for a very long time. They're college friends. They know where I live. So I would not sell without their consent.
So right now your portfolio is, I think, majority rentals, and then you've been starting to do passive investments the last
Correct.
couple years.
More importantly, or equally importantly, I'm not growing that portfolio. I used to buy based on the capital availability of my friends and mine, a property once every 10 days on average. I have bought very few properties, if any, in the year 2022, and it is not likely that I will be buying properties in the year 2023. So there are really two ways to look at this. One way is, am I selling or am I not growing? For the moment, I'm not growing.
It's a great way to frame it. Great. Thank you.
Thank you, sir. The National Diversified Funds, what are those things? In the world of Ironton Capital, we initiate a fund once a quarter. This fund typically is $10 to $20 million in size. It has a minimum of 10 investments, and it is diversified in geography, in asset class, in strategy, and you can hope to get 17 plus returns with a hope of a meaningful upside, meaning even over 20%. This is a 5 to 6 year commitment when we are completely out of all these 10 plus investments, and there is limited liquidity along the way. I don't want to scare anybody. Let me dive into that. Basically, what that means is we have liquid events. We write checks to people when the underlying projects either pay rent or they refinance, or ultimately there is an exit. We cannot provide liquidity if you just want to exit. So I don't want people to think that there is no liquidity. I want to say there is no discretionary liquidity. This is the kind of investment that is most applicable to people who, quote unquote, know what they're doing according to the federal government. They are called accredited investors. There are very clear measures to what makes one qualify as an accredited investor. This is clearly the subject of a CPA, and I would encourage you in the most forceful of ways to not consider playing with fire until and unless you have these discussions. So here is the magic sauce. Imagine a world where we break our reality into 4 segments. One segment is defined, am I investing inside of my 401k or my IRA? And the other is, am I simply investing outside of my retirement? But investors fall in 2 basic categories. Either they are passive investors, non-real estate professionals, or they are active investors who are real estate professionals. Who would be a real estate professional? Somebody who is a broker, somebody who is an investor, and that is the main source of their income, or other services and activities around the real estate profession. So let us assume that one is investing inside of these retirement vehicles, the IRAs and the 401ks. I cannot say it in simpler terms. You can't use your depreciation.
And I can give, I'll give a real world example of that. So, the last couple of years, as I started investing passively, I did it through a solo 401k. So basically, a retirement account where I can invest into real estate. And I've made a couple investments with Terrence Doyle in his Vericove company. And I know earlier this year, he and I were talking about something that's catching up, and he made a comment about how much depreciation was in one of these investments. And, I had no clue. And he's like, didn't you like it? I was like, dude, this is my 401k. Unfortunately, I don't care. It went to waste because it's in my 401k. And he's like, oh, bummer. I was like, yep, bummer. And it was a fact. And it was still passed to me, but I was not able to deduct it from my taxes.
Exactly.
So it was not fully utilized. And,
in many ways, this is unfortunate. And what we are trying to do at Ironton Capital is to remedy this through what I'm about to describe. The overwhelming majority of people who walk the street are not necessarily real estate professionals. They fall into this box. They are investing in non-retirement, and either they do not have enough real estate gains to net against that depreciation, or they do. If they do, it's nice and simple. They have good use for it. If they do not, either they should not be taking it, or perhaps they could be taking, recognizing that they would have to move it forward to the next year, and the next year after that. Here is the holy grail. You're an active investor and you're investing in non-retirement terms. You can use the living daylights out of this depreciation. And more than that, it doesn't even have to offset real estate gains. It can offset your non-existent gains of your Microsoft stock or something else. So how much would that be?
Can I, before you dive into that, I
Please.
want to hit a very a key conceptual point here for people. So, with funds and syndications, depreciation typically just passes through to all the partners, limited partners and general partners, based on kind of their share of ownership. And then that's very common practice, and usually how it works. Now, what Vital's about to describe here, where you can pick some different ways. I want depreciation or I can't. This is a very unique thing to Ironton that allows you to kind of do a little more slicing and dicing and pick the investment that's better for your portfolio based on your tax situation and what type of vehicle, retirement or non-retirement, you're investing into. And all those underlying concepts of the straight line depreciation, cost seg, accelerated, the bonus depreciation, all that same stuff is typically applied to the underlying real estate and flows up to the investors. And now what Vital is about to share is a couple ways that Ironton allows people to slice and dice it.
Absolutely. Let me take a minute and take you back to what Jenny said. The amount of depreciation you will get is what it is. The timing of the depreciation is what will ultimately vary. Additional to this, depreciation will be recaptured at the end of the investment. So it is a tax-free loan. Just like every loan, either you have ideas and good uses for it, or it is not of great use if you're going to put it under the mattress and do nothing with the money. I'm making the assumption, I think it's a good assumption, that everybody listening to this webinar has good use for money and opportunities. Otherwise, they would be spending their morning golfing rather than doing this thing. So we all fall in this general category. Without explaining the mathematics, in an after-tax sense, the opportunity to create value in the way that I'm describing is something that looks like 4 or 5%. That's a pretty meaningful amount if you're looking at 15 to 20% investments. It is an additional 25% over and above what the investment offers. So what happens to the people who cannot use the depreciation? They're just vehicles in this thing? No, they are not. We give those people additional pref, that is another form of value, and that on a pre-tax sense is a number that resembles 1 to 2%. So let me review. Do we create a depreciation? No. Do we create pref? No. What we do is we allocate what already exists in the bucket of our investments to the people who can use it most. And that is indeed the magic sauce.
And going back to my example, if let's say there's two investors, I invest my 401k, Vital just invests from his checking account. We throw in $1 million. I can't use depreciation, he can. So I get a little bit higher return, and the depreciation that would normally flow to me, but would not get put to use since it's in my retirement account, now is redirected to him. So we're both getting a slightly better return without any more risk. That's a better fit for the way we're investing and based on our tax statuses.
Absolutely.
So that's the key concept.
So what you and I have done, Chris, is we have traded.
Yeah.
You have given me your depreciation, and I have given you some of my pref, and we are both better off because previously there was a wealth creator that was being wasted, your depreciation, that you told to your friend that you did not take advantage of it. that is currently not being wasted. And that is the point. I'm going to show you all of these things.
Yeah, and we got a bunch of questions I want to jump into here too. So we'll jump into Q&A soon.
Let me just tell you in the most brief of ways. Iron Capital is an active participant in this market. We study the markets. We network to find the deals. We negotiate the deals so that they're ever so slightly better than you would find them tabulated on the internet. We aggregate cash, $50,000 cash checks, $100,000 cash checks, so that we can write $1 million cash check or a $2 million cash check, which at times is the ticket to the dance in some of these investments. We build this bigger reality, this diversified national portfolio to minimize risk. So we're not only looking at the individual projects, but we're looking at the whole bucket, so to speak. And once we put these in place, we get on airplanes, we pull out our spreadsheets, and we make sure that these things progress as advertised and as indicated. And of course, we do all the paperwork. So what do you do? Well, you have to do probably the most important thing that you can do. Make the decision to allocate your funds. You can go buy that workforce property in Aurora, Colorado, or buy Microsoft, or invest it with Ironton Capital or some other fund. This is a non-trivial, big decision on anybody's life. You write the check, and then you just monitor your investment. You get these multiple checks along the way as liquidity events on individual projects occur, and you get the larger check, the exit check at the end. And to remain in the concept of depreciation, you receive your K1s that spell out that depreciation very clearly, which when combined together the rest of your tax return, it will net against other gains, ultimately resulting on a smaller tax bill to Uncle Sam.
Yep, that phantom loss or paper loss that's you and Jenny mentioned throughout.
You want to jump to some questions, or should I?
Let's jump.
Further?
Let me take the PowerPoint because I do want to jump to some questions here. And Vital, great presentation on here. And I know there's a lot of details here on NDF. We don't have time to go into all that right now, how it's worked out. But I want to keep it focused and appreciate. If anyone wants more details on the NDF investing, click that link or scan that QR code. There was a webinar we did yesterday. It'll take you to it. Actually goes through a lot more detail on there, which goes through diversity on geography, asset class, strategy, and sponsors, and also how the cash flow works out. But we got a lot of really great questions in here. I'll leave this up here. So Selena says, maybe I missed this, but if we choose to do a cost segregation study, do we only need to do that once? Jenny, how does that work?
Exactly. You would only do it once.
Yeah. So it's a one-time thing.
They'll give you a schedule, and you give that to your accountant, and they will be able to just take that schedule for subsequent years.
And then going to a few of these other questions on here, because I see a lot of the comment in the chat box here, is do I have to pay it back? Yes. As I think Vital mentioned earlier, it's an interest-free loan from the government. That's the way to look at it. And there is something called depreciation recapture. And so that means once you sell the property, you are taxed on the depreciation, that interest-free loan you took. So this is where it starts getting more nuanced, and being very dialed in with your tax team is important, because a couple key concepts here is if you're getting that money, like that $50,000 back in Jenny's example, and go reinvest it at 15 or 20%. Can you reinvest it? And that's what you should be doing. That's a big part of the game there where it makes sense to take that interest-free loan. Great, I got $50,000. I'm going to go turn that into $100,000 and then pay this loan back in 5 years at $50,000. Great, it makes sense. Now, there are some ways you can defer that. A lot of people know about doing a 1031 exchange, which helps you defer capital gains. It can also help you defer your depreciation recapture as well. So that's another thing to keep in mind as you do 1031 exchanges. Now, can you sell a property, like sell Jenny's fourplex example, and then go do a 1031 into a real estate fund? No, you cannot. Generally speaking, in Ironton, you cannot. Most funds, you cannot. If you're writing a couple $1 million check, people make some exceptions for you typically, but for a couple $100,000, all the headache and paperwork, most funds and syndications will not allow you to do that. So on the passive side, you will be, since you can't 1031 in or out of it typically, you will have some of those capital gain events and depreciation recapture events. So again, you want to be prepared for this, and you should still be making a greater return on that money. So what a lot of people do is that money comes back from their past investments, go buy new investments, like a new passive investment to capture depreciation, or go out there and buy a new rental and do a cost dig and capture some of that depreciation, help offset some of those gains. So I'd say I see a lot of savvy investors, and I get to talk to a lot of people between doing the podcast and the Property Llama stuff. A lot of very successful investors, and a lot of people are blending the two of those. And they are active participants. They understand the concepts, and they've got their tax team aligned with them. So get the concepts there and make sure that you can understand it so you can work with your team and direct them. Jenny, Vital, do you guys want to add anything on there to clarify or that I may have left out?
No, just as you said,
I think
speak with your tax team and get a plan in place before you take action on anything.
I would like to drive the point of the interest-free loan.
Great.
Imagine that I give you money that has no interest, and you can put it in a bank account, nice simple bank account that happens to give you 5%. You put $100. The $100 were not yours. The government gave it to you. And the first year you get 5, and the next year you get another 5, third year you get 5, and then the government says, give me back the $100. You just created $15 literally out of nothing. That is the tax-free loan. So do not be afraid of the depreciation recapture. See it as part of this construct that the government is doing to basically create economic activity.
Yeah, it's I really, this last year in 2021, I did a few cost sig studies and did all that front load depreciation that Jenny was sharing, and really saw like the personal impacts on my tax returns, and also like the tax refund check I got was bigger than anything I've ever had in my life before. Like I understood it on paper, then I just went through it myself this year, and it blew my mind because I got a huge chunk of money back, and I can go out there, like I said, reinvest it, and yeah, I'll pay it back in 3, 5, 10, 20 years. But if I can take that money and double it every 5 or 7 years, I'm happy to pay that back in 7 or 10 years. So have a plan with it. I think everyone's on this call smart enough not to take that money and go do silly things and buy liability or stupid things and vacations and blow the money. Go out there and reinvest it is the key. So moving on to the next thing, because I've seen a few examples of this year of some failed 1031 examples. And here's how maximized depreciation can help with some failed 1031s. Of course, talk with your CPA, but I've talked to a few clients where they sold in the spring, early summer, got some really good prices, and as the market turned with the interest rates, they got caught not being able to do the upleg they wanted to with interest rates and new debt coverage ratio. That happened to 2 people I talked to. One person was, I think, selling Colorado and going to 1031 to Florida. well, a hurricane came through there and kind of just, literally like through those, made those plans not possible. And so I talked to a few people with failed 1031s. So two ways you can go out there and help mitigate those capital gains and depreciation recapture is go out there and still buy a rental property, do a cost seg study, bonus to depreciation, all that stuff to get a big write-off or big tax loss this year, or go invest in a passive investment like an iron and capital fund and do depreciation shares, or do a fund that will have some underlying cost segs and all that to pass through depreciation. So of course, talk with your accounting team and your CPA team about that, but there are some opportunities in those failed 1031 situations as well. And shifting to some questions on here, we got a few minutes left. Jackie says, can you 1031 into NDFs? No, you can't. You can't for the Ironton stuff, and most passive funds and syndications, you can't. From a technical level, you have to pretty much be a tenants in common, which is how these products and investments are not structured. If you're writing a really big check, like $1 million plus, well, that usually changes some tunes. But for the average, I'll say mom and pop investor, it's just not a reality, unfortunately. Trust me, I've looked at that myself numerous times. I want to blend these two questions here. Steven says, how are capital gain taxes handled in this type of fund? I don't believe it's possible to use a 1031 either on the way in or way out. Is that correct? Yes, you can't 1031. And Vital, I think if you can talk about this screen on the right side here and what this is, this will help understand the timing of cash flows and how cash is returned.
Absolutely. In effect, by looking at the right-hand side of this, what you see is somebody is making an $100,000 investment, and then from the underlying projects, you're getting checks. The checks come either from rental income or, more importantly, from refinancing and exits. But all these do not happen at the same time. That's why you see this varied cash flow. In this cash flow, you're going to break even roughly on year 4. And after that, all the money that you make is money that is over and above your principal that will ultimately create your return that we're advertising as 17% plus. What we are trying to reduce the tax bill as much as we can is we name the early cash flows as return of capital. So without running afoul of tax principles, and we're always advised when we do these things, until you get back your principal, hopefully you should have no or very little taxes.
And to really drive home the point, the reason is that return on capital isn't a taxable event to you. So like in years 2024 and 2025 and parts of 2026, you start getting cash back, which is cash in the bank, but on the K1s, they're not getting taxed. And so it just, again, it allows you to pay the tax a year or two later, essentially, which just allows you to invest and just plays that tax game.
But let me highlight in the least of ambiguous ways. This cash flow that you see on this page does not include depreciation. This is real cash, like green American dollars cash. The depreciation is phantom cash. The loss that you get on your K1 is an additional gain. This is the 17%. It doesn't show the 4% over and above this 17% that you will gain through the depreciation. There are $100,000 investments that show a 50,000 loss on year number 1. You take that 50,000 loss and you reduce your tax bill. That is not part of this graphic. It is additional to this graphic.
Another question here. Did I hear it correctly that the depreciation received at the end of the investment and not annually? That is not correct. So for examples, in rental properties, you do a cost seg, it's going to apply to that tax year typically. In the fund example, it's going to be based on that year. You'll get a K1 every single year from a syndication or fund passive investment. And that K1 is going to show you the depreciation that you did or did not gain that year, in addition with, other expenses and other income. So no, it's done at the annual level. So let's see here. I think I'm kind of going through the slides here. Oh, yes. A couple of things to keep in point. Jenny, this is all you.
All right. So I know Vital mentioned this, but just to kind of drive the point home and just bring these questions to your accountant. I think that's probably the best way to preface this is just these are talking points for you. So generally speaking, rental real estate losses are treated as passive activity losses, and they can only be offset against other passive activity income. So read between the lines, rental income, rental losses. So any passive activity losses that are unused and you're not able to deduct against it, the loss is then carried forward. However, the special rule here is that if you qualify as a real estate professional, and Vital talked about this earlier in his presentation, the passive activity losses don't apply. So if you are able to qualify as a special IRS designation, you can offset ordinary income. So really, just to kind of wrap this up, if you are doing an accelerated depreciation study, check with your accountant to see if it even makes sense for you. If you're not a real estate professional, do you have enough passive income to make it worthwhile? If you are a real estate professional, do you have enough W-2 income for this to be worthwhile? So it's really just these are talking points that you need to present to your accountant and see for your individual situation whether or not doing a cost segregation study utilizing accelerated depreciation makes sense for your specific case.
Perfect. Very well said, Jenny. So, with that, we'll kind of wrap up. We can take on a few more for some questions here. As you can see, cost segregations and maximized depreciation doesn't make sense for every investor based on their tax status and or how they're investing their money in retirement or non-retirement accounts. So key points here is understand the concepts of depreciation, how you can front load it, understand different ways it can apply during active and passive and how you invest, and then go out there and have the basic education, do your research, and talk with your CPA. Now, if you need help with referrals on CPAs, reach out to us. We're happy to recommend them. And I would also recommend if you have, I know there's a bunch of questions. Hey, what about this property for a cost seg, or how to estimate the benefit? If I go back in time and tell, Chris Lopez 2 years ago, I would say, Chris, go talk to a cost seg person earlier rather than spending 2 months Googling pointless stuff, trying to figure out stuff. Most cost seg people can give you a very quick estimate based on a few inputs and give you a really good ballpark. So lean on them, and I would reach out to them. If you need any recommendations of cost seg, let us know. We've done some here. We've got a great local one we work with that has been a great fit for some clients. So happy to share that. Reach out to us or email info@Envision. And a couple other questions here. We'll wrap up. Robert says, again, how is this regulated? I'm not sure if that's a reference. If you can clarify if that's on the cost seg stuff or the fund stuff, come back and clarify, Robert, then we'll answer that. Peter asks, when do you make the request for extra depreciation for giving that higher payout on NDF 5? And this is a specific fund for Ironton. This was an NDF 5 question about the different share classes.
In NDF 5, we did not create these two classes of shares, the one that gets more pref and the other one that gets more depreciation. Starting in NDF 6, we're making this distinction, this selection. You say that you make your preference very clearly up front, and in turn, what the fund does is it assigns you the appropriate share class.
Yes. So that was actually, if you're an NDF5 investor, this is not an option. But it's actually one of the things that came out as we were looking at all the investors and seeing, how much were in IRAs and 401ks and some other vehicles. Like, wow, well, that depreciation is going to waste. It's not being utilized. And then start off a discussion, and then I don't know, 6 weeks later, there's now share classes. So that's an ongoing thing.
If I can highlight, this is another way that a company like Ironton Capital creates value. We stay on top of people's needs, and we recognize these opportunities to give people what they really need, as opposed to giving everybody the same meal, so to speak.
Yes, it's got a little buffet choice here. All right, couple other questions, and Robert clarified it. What agency, like the SEC, regulates, I guess, the fund investing, and who watches out for investors?
It is my understanding that these funds are private partnerships. They are liable to multiple laws and multiple regulations, including SEC regulation. For example, it is the SEC that would require that you be accredited investor. It is the SEC that would determine if the professionals working in these funds have to have this kind of licensing or some other kind of licensing. So yes, we are regulated, and this regulation is meant to keep the investors safe.
Yeah. And I think a big reason, they have the accreditation status is they're assuming the accredited investor, I'm using air quotes, is more knowledgeable, do more due diligence than the average unsophisticated investor that is going to be, taken advantage of. So definitely do due diligence. Some funds, will have audits and all that. So there's definitely layers there, but ultimately it falls on the investor's own due diligence as well. So great. I think that answers all the questions. All the recording, these notes will be in the student handbook session. If you guys have any questions and want to help with your individual portfolio and figuring out stuff, please book your 30-minute portfolio analysis session. If you have specifics on the Ironton Capital stuff, reach out to us, and Nick on that team will talk with you. The PA 30 sessions are really focused around your portfolio. Not going to go into the details of Ironton on there. So I'd recommend doing both. But we would love to sit down, talk with you, help you figure out the next best moves for your portfolio in these changing times. Jenny, Aaron, Vital, thank you guys so much for coming out. I appreciate it. Thanks, everyone.